Howard Friend joins us now. He's the Chief Technical Analyst at MIG Investments. Very nice to see you. How are you? Let's talk about the chart that's had everybody excited this week, the S&P 500.
Right. Well, S&P 500, there's a bit of background, obviously. For the last several years, it's been trading in a very big range. Big bull markets followed by big bear markets, which typically have followed false breakouts of multi-year highs and lows. Now, the recent action from the March low has been very constructive. One thing that I noticed that these are monthly candlesticks, by the way.
Yep.
They're numbered. What the numbers represent is when the close is above the high of the previous month.
Right.
And that denotes aggressive demand on that month. Now, in a sustained bull market, you'll see several of these in a row, and you won't see too many in the opposite direction. In fact, when you do, like for example just up there during the bear market, within a couple of bars, in this case a couple of months, the low was taken out and the bear market resumed. So the action from the March low has been very constructive in that respect, and therefore I expect the pullback that we've seen over the last few weeks is corrective ahead of a push to new highs.
Right. So buy on the dip, still that is the advice that's coming out from your perspective?
I believe so, yeah. In addition, we've actually made 4 consecutive higher closes on a monthly basis as well, and that is bull market action, not bear market action in my opinion.
Do other charts contradict that? Because there's a lot of charts that's come on this week and talked about the head and shoulders formation, breaking through the 200-day moving average. They see that as being very pessimistic.
Indeed, but that's a much shorter term outlook, I would say.
Sure.
Typically, you'll get the head and shoulders pattern against a trend, and it will fail after several weeks.
But you have no sense that we're going down, retesting those March lows, anything like that?
Absolutely not. No, as I say, going back to the structure of the rally from the March low, I believe that we will stall above this red line you can see here, which is the bottom of the first thrust bar, which is labelled 1 on the chart. So I believe we'll stall above there, and then we'll resume this uptrend that we're starting.
Well, let's move on to the next chart, which is a foreign exchange chart. Logically, from what you're saying, I should be selling the dollar.
Indeed. Totally agree. The dollar, the background to the euro-dollar, we had an 8-year bull market which saw the euro nearly double in value. Then we saw the big shakeout back end of last year, which has stalled above the 50% retracement of the entire move from the 2000 low, which again is bull market action. Looking at the shorter term, the monthly bars, or candlesticks in this case, you'll see that the thrust bars, the close above the previous month, they're occurring to the upside from the March low. So again, this is very bullish short-term action. The big picture is actually bullish too. And from the pullback low at 123.30, we're actually we're forming a big range, as you can see. Swings up, pulls back, swings up again, nice stepping higher action. Once we get through 147.20, which I believe we will, that will tell me that we're resuming the long term.
Getting up here?
I believe so, yes.
160.
Indeed, we've had a 50% retracement almost, and now we're starting to resume the uptrend for the euro, the downtrend for the dollar.
Howard, love to see you. Thanks for bringing in the charts. Howard Friend joining us from MIG Investments.